So let's talk about that volume analysis. How can volume patterns on the chart be interpreted to understand buying and selling pressure? Abhi?
So I know that a lot of traders use volume, but it's subjective, and I've never figured out to read the volume in a decisive way. So when I'm trading stocks, I don't look at volume at all. And at the same time, I do not trade stocks that have very low volume. If I'm swing trading, it has to be 500,000 or more. And if I'm day trading, it has to be 1 million or above at a daily average daily volume. And once I put the threshold, I don't look at any other stocks, thinly traded stocks, because there's huge gaps, huge spreads. I want to avoid that. But once that is implemented, I don't worry about volume for stocks. But when it comes to futures, I look at intraday volume. The reason is because when I'm looking at where I want to enter, I want to enter in high volume zones. So high volume zones are pretty, usually it's either the London Open or US Open.
Okay.
And if I'm trading an Aussie dollar, then I'm looking at Australian Open. Else, all the other zones, like for example, if I'm trying to enter around US lunchtime, there's no professional who's trading. So if you get into those low volume time frame, you
Mm-hmm.
can easily manipulate it, because if it takes billions of dollars to manipulate a market, when there's not much volume around, when they're not the big boys playing, then it takes much lesser money to manipulate the market and move the market. So you don't want to be in that kind of a situation.
Got it. Got it. So you have to be very
Yeah.
cautious on that volume analysis perspective.
Yeah.
Right. Time and volume is very, very critical. Right.
Right.
Okay. Great. Okay, so let's talk about for that chart patterns, Abhi. So are there any recognizable chart patterns? For example, head and shoulders, double bottom, present, and how might they influence the stock's future direction?
Yes. Um, so there are some chart patterns which are, for example, the double top or double bottom. A lot of times they show the market tops and market bottoms. But it's also important to recognize, the context behind that. Just because a double top happens doesn't mean that that's a market top. And just because a double bottom happens, that's not it's a market bottom. That's where, because if something becomes common knowledge, institutions use that against the individual traders. So trading is a art of deception. It's a battle, right? If
Mm-hmm.
everybody knows the battle plan, then that battle plan is no longer effective or no longer can be used. So typically, those are used as a trap to trap the retail traders, for the institutions to take a bigger position or to disperse their position. So, every time you can see these traps set up in the market. So for example, let's look at this, right? I'm going to remove all this, and then let's look at. So if you look at this, here's a double top, and
Mm-hmm.
we can say, hey, that's the top of the market, right?
Mm-hmm.
But you'll also see here's a double top. So when the retail investors were convinced that here's a double top and we're going to go down, the market rallied up and took out all these buyers and sellers. So
Mm-hmm.
I'm not saying that they won't work, but you have to be cautious, because people are, big institutions will use them against you. It's not about what you see, it's about where you see them. That context is very important.
Got it.
If the
Got
market is like very stretched and you see a double top, there's a good chance that the market could turn around. Again, as a trader, my goal is not to guess, hey, the market's going to go down, hey, the market's going to go up. I'm not there to brag anywhere, and I'm
Mm-hmm.
not there to call the tops or call the bottoms. if I see that there's an opportunity to go down, I'll hedge my positions, or I'll, buy some puts on the position. If market turns around, I close the puts and work with the longs. So it's about making plans and working with them.
Got it, Abhi. So are there any confirmation signals from different technical indicators that strengthen the overall technical analysis of the stock?
So my technical confirmations all come from the price. And whenever I'm looking at charts, I need to see the trend change. So for example, I showed you how there's an uptrend goes into a sideways trend, and sideways can go into a continuation of uptrend, or it can go downtrend. So those are the signals that I watch for. So for example, once I'm in a sideways trend, I'm looking for confirmation signals of that sideways turning into an uptrend and breaking the sideways pattern. So that's my confirmation. And I look for zones. I look for the trends that break the trends, opposing trends. So for example, there's a sideways trend and there's an uptrend. The uptrend breaks the sideways trend, then the uptrend is valid. That's my confirmation signal.
Okay, got it.
I do not use any indicators. I don't use trading price. Price is my only indicator. That's my primary indicator.
Got it.
Sometimes I might use a MACD to see if the momentum is slowing down, but I won't enter into any trade just because an indicator said so. So they're just more like okay, I'm convinced my price is, this is what the price is telling me. Let me see what the indicator says. If there's, agreement, and then I might say, like, my confidence goes up a little more, then I can go buy it.
Got it, Abhi. Okay, so let's talk about that risk management strategies. Considering risk tolerance, what risk management strategies, for example, stop loss orders, would you recommend to mitigate the potential losses?
Yeah, absolutely. So when I'm trying to accumulate a position in my long-term wealth account, I don't usually use stops because I sell options to get into a position. But other than that, all the other positions, you have to use stops. And I've learned it the hard way, and I don't take a lot of positions. I don't get into a lot of positions without knowing what the risk of the trade is, and to see if the trade actually offers an enough opportunity to make it worthwhile to take that trade or not. So if, let's say, you go buy a lottery, or let's say you go to a casino and play 21, right? So they say buy-in is $20, and then you want to know how much would I win. So your risk is $20. It's not gonna go, you're not gonna lose more than $20. And you want to know how much you win, so you're gonna double your money, so you're gonna get $40, right? So that is the same approach that you need to have when you're taking on a position. So for example, let's say if let's say I buy S&P right here, right? So let's say I'm thinking, so this is the tool that I use. So if I'm thinking, okay, this is where I want to get in. And I would say this is my stop loss. Come on. So I want to get in here, right? And then, this is my stop loss, right? And I'm thinking the price is going to go all the way to $530. So this is my estimate, right?
Okay.
And if I go here and I look at it, it tells me exactly how much my risk is. My risk is $100.
Okay.
So I can say, typically there's a percent rule that you want to use. But again, I would say Just because you have a big account doesn't mean that you should take bigger losses. It is based on your comfort level. If you are comfortable losing $100, then use $100 as your, guidance. And if you're feeling the pain, if you, let's say that you took 3 losses back to back, you lost $300 and you're going to feel the pain for my next trade and it'll make you not take the trade, then I would say reduce your risk level. So you can go 0.5% based on your account size as a risk for day traders. And if you're long-term well positions, you can go 2% as your risk threshold. But if you have $10 million account, you don't want to go too big on your risk, that's fine. Use your comfort level. Okay.
Got it.
So I can say, let's say my account threshold is $200. This will tell me how many positions, how many stocks I can buy. So this also segues into the position sizing, and always use this. One thing that you need to be aware of is stocks will gap, either overnight gaps or there's big earnings coming up. For example, Nvidia is coming up, so QQQ can gap up or gap down based on how Nvidia moves or Apple moves or any of the big tech guys move. So if you're using that, you might end up losing way more than the $200 that you set out to lose. So use your caution, use your best judgment, but definitely use stops. Definitely stick to a consistent risk plan. So the risk plan is very important to be very consistent. The reason is because it's a probability game. So you want to take, let's say, you want to take 10 trades. And if you make 5 winners and 5 losses, your 5 winners should go way above your 5 losses. If by chance your losers are all $1,000 each and your winners are $500, $700, $200, then it's a losing game.
Yeah.
So you have to control your risk and make sure that if you take 10 trades and 3 of them make $3,000 and the 7 of them lose $100 each, it's a winning strategy.
Got it. Got it. Yeah, that's a good approach,
So,
Abhi. Yeah. So I think you talked about that events, right? So how would technical analysis hold up under potential market stresses and unexpected news event, Abhi?
so there are certain news events which are designed to be more like a catalyst. The big institutions know where they want to buy, where they want to sell, irrespective of what the news comes. It could be a good news. They could take in all the buyers and crash the market, or it could be a bad news that a retail trader would start selling positions and they would buy all positions from a retail trader and drive the price high. So those are premeditated by the institutions. And then there are things like totally unknown, like suddenly events like 9/11 happens, Iranian war happens. There, less institutional traders are privy to it. I'm not going to say that nobody knows about that. I'm sure some
Yeah.
people
Yeah.
know about it and they take advantage of it.
Yeah.
But a lot of people don't know it. So the way that I see news, every day I look at my calendar for the news and what news comes out at what time. And the purpose of that is not to go and analyze the news. I don't care about the news. I don't care about the jobs report. I don't care about the numbers that come in. I don't care about what Fed Chair Powell comes and says that he's going to increase the interest rate or decrease the interest rates. None of that matters. But the timing of when it comes matters. So you have to be aware. So if I know that Chair Powell is going to come and talk at 2 o'clock, I know, or the numbers are going to come at 2 o'clock and he's going to come and talk at 2:30. I know that at 2 o'clock, the market is going to be like too volatile. Either I totally get out of the market on my short-term positions or I add hedge to my long-term positions. That's what I do. And once 2:30, 3 o'clock, the market settles down and picks a direction to go. And then I join the trade. It's very difficult. It's easy to say the market's going to move a lot. Let me get into a position. but a lot of times it's a gamble at that point. You're not relying on your technical analysis. You're relying on your gut feeling, like, okay, they're gonna say no interest rate hike, then let's go high. Like, that's not how markets work. So be aware of the news, be aware of the earnings. Earnings is, totally what the market perceives as the earning. They could publish the great numbers and still the stock could drop, or they could, publish like pathetic numbers and the stock could still rally. So it's about what everybody perceives at. So try not to be in the market. Like, if you want, hedge yourself, make sure that your risk is not unlimited risk. But other than that, use your caution.
Got it. Got it. So position sizing play a very vital role, right?
Yeah.
So based on analysis, what is the recommended position size for percentage of portfolio, Abhi?
So the way that I do it, I'll use the risk to guide my position sizing. So for example, let's say I'm allowed to risk, based on my account size and my risk tolerance, I'm allowed to risk $500. Okay. And I feel that this is a great area to get in. Okay. I'm going to say, here's where I'm going to get in. And if I'm wrong, here's where I'm going to get out. Okay. And I'm thinking, at least I should take my first target here. So this is where my entry is. This is where my stop is. This is where my target T1 or T2 is.
Okay.
So now I'm going to go and analyze my trade, and I can take a maximum risk of $200. So I'm going to say I'm okay to risk $200. And this is going to tell me exactly how many stocks I can buy based on my risk. If that's my stop, I can buy only 37 shares.
Okay.
So my position sizing is based on my risk, and my risk is based on my account size and my risk tolerance. And that stays the same consistently. Like, I don't risk $1,000 on one trade and $500 on another trade. It's vastly different. Those numbers will mess up your, your numbers. So you don't want to, you don't want to keep them inconsistent.
Got it. Got it. Always follow the best practices, right?
Yeah.
No emotional decision making, right? Always.
It's very easy to say, don't be emotional because there's money involved. Your emotions will run high. But you can let your emotions drive your decisions.
Understand. Yeah.
The more you take hit, the mind matures. But I won't ever say that, you'll never be emotionally affected by your trades. It'll be there. We're humans, it'll always be there.
Yeah, agree. So, but good suggestion, Abhi. So let's talk about that historical performance, right? So how has the technical analysis approach performed historically for a similar stocks or market condition? Is it very important to consider before making the decision, Abhi?
So when I decided that I want to go down this path of, in the financial world, I had two different choices, right? Either I can go down the fundamental analysis path, or I can go down the technical analysis path. So fundamental analysis, you're looking at their earnings per share, what, good prospects they have as a company, and, all the different aspects that a company does and their future, their perceived nature of the stock, right? And then there's this technical analysis where it's about supply and demand, where you see where people buy and where people sell. The problem with fundamental analysis is it's very time consuming for each and every single product. So if I want to analyze 10 different companies in 10 different sectors, You need to understand all the 10 different sectors. You need to understand all the companies, their competitors, who's going to come take out their lunch money. It's a very, very, first thing, it's a very time consuming process. One. Second thing is, the fundamentals remain same at least over a quarter, right? If fundamentals are really true, one quarter to another quarter, the price shouldn't change. So yesterday, Google's price versus today's Google price, there's a huge change. What do we know about Google fundamentally that has changed in the last 1 day or the last 2 days, in the last 1 hour, last 5 minutes? Nothing, right? So technical analysis comes in because it looks at people's behavior, and it looks at where people are buying it, where people are selling it. It's the supply and demand. So however things change on the fundamental aspect of it, it all manifests in the technical aspect of it. So if you learn to read the technical aspects, the fundamentals will always, the information in the fundamentals will manifest in the technical analysis. I won't know if CVS is going to open 10 different stores because they expect the market to go high. I don't know, and I don't care, honestly. I just want to know there are more people buying, if there are institutions buying, which means that the institutions know something that I don't, and that stock, the price of that stock is going higher, and that's where I want to buy. I'm not saying that it's foolproof, because institutions are paid to make sure that not everybody follows them on every trade. So they'll set up a lot of traps where they will fake out, they'll pretend they're buying and they'll be selling, they'll pretend they're selling and they're buying. The more time that you spend in the market, you start to see those patterns, and you got to be wary of that. But technical analysis is, the price is like, it's what's happening in the real time, right? If price goes from, here to here, it's a battleground. That's where the buyers and sellers are fighting. And if you follow that battle plan, the overall picture of, I don't know what's going to happen in 10 years from now, but I know what's happening right now. And then you follow your plan based on what's happening right now and what's coming next. Instead of saying, I buy Microsoft today, 20 years from now, I'll have 5x the account size. Probably, most likely. But you can base your decisions on that.
Understand. So then thank you for sharing, Abhi. A lot of good best practices.